was reading through the news, as I often do, looking to put these segments together, and I came across an article that said Bank of Montreal recently tested Canadian households to see what the impact of a 2% interest rate increase would be. And I guess the results were that if interest rates went up by 2%, more than 50% of the households that they talked to could still afford their life, could afford their home, their mortgage. It wouldn't be a big problem. 20% of the people that they talked to said that they couldn't afford anything. In fact, if the interest rates went up by 2%, that would probably really have a massive financial impact on them and their family. And 23% of them said they didn't know what would happen if interest rates went up by 2%. They didn't have any kind of contingency plan for that. They didn't know what the result would be if it did happen. So I got thinking about this in the context of if you own a business and you have commercial financing, could your business survive a 2% increase in interest rate? And as I get thinking back through the businesses that we've worked with over the past years during this incredibly low interest rate environment, there were a few things that became apparent to me, which was, first of all, many private businesses, and we define that as they're not publicly traded, they have less than 500 employees, so they might be small businesses or medium-sized businesses, but they're private businesses nonetheless. Many of them don't really consider the cost of financing when getting it. In fact, most of the times that clients are jumping on emilynow.ca to request help for a business loan is usually because at the 11th hour. There's been a critical event or something that's already happened that they didn't get paid on an invoice, or maybe their business now, that the partners aren't getting along and it's gotten to the point where someone just said, look, I'm going to buy you out. So many times the point at which we get involved with businesses is at a point where the cost of financing is less of an issue, and simply getting their hands on the financing is the key. And so could they withstand a 2% increase? I think the answer would be sure they could, because many of them aren't really thinking about that. They tend to be pretty ambitious and they know what they can and cannot do, and so they'll tend to take the financing at any cost. I know of businesses in the past couple of years, since the downturn, certainly in 2008, where businesses are paying double digits for their debt. So they're already paying 2 to 3% a month for factoring or accounts receivable financing, and the providers of that money, they don't really price their money according to prime. So the fact that the interest rate might go up by 2% a year, would be very negligible for these private lenders that are charging 24 to 36% a year, and businesses are paying it. Now, I put a bit of a caveat in there in that many of those businesses that are borrowing that money at those kind of interest rates, they're only using the money for a short period of time, so they tend to be factoring an invoice. So maybe the longest period of time that they're paying interest for is 60 days or 90 days. And so when I say 24 or 36% a year, that sounds like a really, really big number, but they're only borrowing it for shorter periods of time. That's the annualized rate that they're paying. But the real cost on a per day basis, they end up usually just passing on to their customers. So many businesses can find a way to cover that cost quite easily, but it is important to know that 2 to 3% is still 2 to 3%. Profit margins, from what I see on a daily basis, profit margins aren't really, really thick in many businesses. In fact, I would say that many businesses since the downturn continue to operate on a very, very lean basis. They're efficient. Technology has helped make all of us more efficient. The cost of their labor has gone up, certainly in our city, in our province, and so the margins are still very thin for a business. And if a business is paying 2 to 3% a month, hopefully they're only doing it for a period of time and ultimately moving away from that or fixing the problems in their business so that they don't have to keep borrowing that money. But a 2% increase I don't think would affect many of the businesses that we end up interacting with every single day. Prudent businesses, of course, they plan their resources and they steward them well. They will look into the future. They'll say, here's what our business is going to do over the next couple of years, and they'll sit down with a company like ours, go through a website, emilynow.ca, and try to understand, okay, if I need money And if that's the kind of income I need to generate to pay for that money, how are we going to do that? What's our business strategy? So they'll have a plan to help them understand how to make adjustments to their operations, to make adjustments to their finances as the market changes. My thoughts would be, because interest rates are so low, you have one of two options right now. If you're carrying a bunch of debt, and if you look at your balance sheet, and I know lots of businesses like this, they have high rate debt, they have low rate debt, and between all the debt that they have, it's probably kind of low teens or high single digits, that today is the day to refinance that stuff, consolidate it, and pay it off quickly, because the cost of capital is very low today. Or if you know that your business is going to grow and expand, borrow money on a term basis and make sure that you've got a plan for paying it off by the time the term is over. And it's a great time to be borrowing money. The misconception is that banks are impossible to get money from, and the truth is they're not. You just have to know what you're doing. And so to that end, we would encourage you to visit emilynow.ca, where you can see what's required to get approved. In fact, not only can you see what's required, you can see all of the banks in the marketplace. We have scored them for you, so you can take the score that you get at the website and you can match it up with the score of the banks and try to make the connection to see what options you might have. But in addition to that, you can see the interest rates, you can see the money you're going to have, the monthly payment, the documents, the questions that you're going to be asked, sort of all of it. And so we would encourage you to do that if you're looking to borrow money. And in this low interest rate environment, it might be something to consider, to not keep pushing down the road, because one day I don't think interest rates are going to be this low. I don't know what that day is. I've been saying for years that I thought it was going to go up, but it hasn't yet. So that just goes to show you, we just never really know for sure.